Okay, guys, a second ago we learned how to handle a situation where a company issues bonds and they are issued at a discount. And now we're going to take a look at how we would handle or how would we account for a scenario where a company issues bonds at a premium. So if you recall a second ago, a bond was issued at a discount when the market rate or the contract rate that the company was offering was not as good as what people could get elsewhere in the market. A bond premium is just the opposite. So now in this case, our bonds, $120 million, are being offered at 14%. However, people can only get 11% elsewhere. Okay? So we're offering a far superior rate than the rest of the market, and because of that, people are willing to pay extra for our bonds. So take a second if you want to and pause the screen here or pause the video and scribble down some things, or maybe print out to do a print screen or a snapshot of your screen and print this stuff out. Okay, guys, so now we can see here the solution. Now remember, we only have to repay $120 million at the end of, as the problem stated, 20 years. So we have 20 years at the end. We're going to have to repay $120 million. In the meantime, we're going to have to pay this $8.4 million every 6 months, right? Semi-annually means twice a year. And once we get to the end, we will have amortize this full amount of the premium, and it will all be gone. So go back and take a look if you haven't watched yet the video on discounting, because I go into a little bit more detail. But basically, we're given the amount of proceeds that we received, and we're told in terms of, well, we're just given this number here. We know $120 million is what we have to repay. So the bondholders essentially were willing to pay collectively $28,882,608 extra to have that difference in the interest rates. We're offering 14%. The market was only offering 11%. So that 3% interest rate on that $120 million, that ends up being a good bit of money. And the market was willing, people were willing to pay this premium on the bonds. Okay, so notice here we're getting more than what we're going to have to actually repay. So when it comes time to calculate what the interest, the actual amount of payment we're going to have to pay to the people, notice because this wasn't issued at par, there's a difference between the market rate and the contract rate. There's a difference between what our interest expense is and what we have to actually pay. We get this $8.4 million by saying, okay, we have $120 million that we have to pay. We're talking about an interest rate of 14%. So when we say $120 million times our contract rate of 14%, we're looking at $16.8 million. That's per year. But so if we take that amount and divide it by 2, because there's 2 6-month portions of a year, we get $8.4 million. Okay, so that's the first step, is to calculate this. So this is the amount that we're going to have to pay. Then we look at whatever the premium is and divide it by the number of years, which was 20, times twice a year, because it's semi-annually. Most bonds pay the interest semi-annually. So we say, okay, there's going to be 40 payments of interest. So we take whatever the premium is, divide it by the number of payments that we're going to be making, 40, and that's going to give us this $722,065. So by the time we get to the very end and make that last payment, we're not going to have any more premium left. It will all have been amortized. We will slowly have gotten rid of all of that. So you can see here, had these been issued, if the contract and the market rate was the same, our interest, like I said, expense would be the same as this actual amount of cash outflow for interest. Okay, we can see here this premium has essentially reduced our interest expense, hasn't it? Instead of being $8.4 million, it's only $707,677,935. So this premium here, the fact that they were willing to pay more for this $28 million extra for these bonds had the effect of essentially reducing the cost of borrowing that money. Okay, so we can see our interest expense is going to be a little bit lower. So whenever it's time, once every 6 months, to make that payment, we're going to make a journal entry that looks just like this. So remember, this was for 2012, and then this was for June of 2013 here, this entry. And there was a question there that says, will the bond proceeds always be greater than the face amount of the bonds when the contract rate is greater than the market rate of interest? And of course the answer is yes. Investors are willing to pay more than the face amount of the bonds when the interest payments they will receive from the bonds exceed the amount of interest that they could receive from investing in bonds elsewhere, right? So if we're paying a higher rate, they're going to be willing to pay a premium for it.